Hi, everybody. Welcome
I,
to, I should say, Megan and Matt's market update.
I made the top billing. That's good. I'm happy to.
Yeah. So today we're just going to be talking about interest rates and kind of comparisons to last year as we were diving into this conversation a little bit before we started to record. So Matt, tell me a little bit about what you think.
Well, interest rates were set up for something really interesting last week. Last week was a huge data day, and we had some negative GDP predictions. We had negative job growth predictions from ADP. We had a kind of flatlining month to month inflation numbers. And so what we needed at the end of the week in order for rates to really push past the current level of resistance and start to drop was a bad jobs number. And we just did not get a bad jobs number.
Mm.
So something's interesting. The jobs numbers have all been revised downward each and every time we've gotten them for the past, I don't know, 18 or 19 months consecutively or something like that. I remember last year there was a bit of a controversy because a lot of these job openings that are listed are kind of ghost jobs. They don't really exist. They just exist to make it look like the company is hiring. And a lot of people share that experience online. If you go on and you say you apply and there doesn't seem to be any realistic end game to it, it's a $40,000 a year, but we require masters plus 10. And that, obviously no one's going to do that. So the jobs numbers themselves would have been the last kind of piece in the puzzle to make the Fed go, all right, we got to start doing something now. And it didn't happen. So we had the sort of a short-term hopefulness last week that rates were going to start their descent, and it never kind of came to fruition.
So I'm wondering when I hear that, we've been trying to get the unemployment to go up, right? Like we've been waiting for these numbers to reflect. I've spoken to people who have experienced job loss, are anticipating layoffs within their organizations. So what's happening? I can imagine that some people are doing a lot of more commingling households. People are living together. I think you have different opportunities now to make money on the internet. I think people have got things like Uber Eats and Lyft, et cetera. And I think that that is how these numbers haven't been lifted in the unemployment sector as high as they should be, and they aren't being reflected that way because more and more people I talk to are looking for co-living situations for friends or family. In fact,
Mhm.
I'm speaking with a gentleman in Utah who was looking to buy a duplex. Him and his friend were going to rent the top unit to split and rent the bottom unit to somebody else
Right.
to offset mortgage costs, to reduce, what's going on. So I think that's really interesting. I don't think it's fair to hinder the market because people are getting creative and finding ways to stay afloat personally. But those are
Yeah.
just some things I'm listening to. I don't know about you.
That's also interesting as well, because when you're talking about the different measurements of employment, sometimes we're talking about household employment, and sometimes we're talking about individual employment. Sometimes we're talking about employable employment, those who are only in the workforce. And or we're talking about people who are leaving and coming back to the workforce. There's also something called the JOLTS report, which is the job labor turnover, right? So
Right.
um, there's a natural birth and death cycle as well to how many jobs one would expect to be created in a given month and how many jobs one would expect to expire within a given month. So it's an incredibly complicated calculation. But by and large, I think what's happening is a lot of the strong jobs numbers are people getting second jobs, people combining households and putting things under the same roof, or combining tax bases and liabilities. I I feel like a lot of these numbers are twisted towards looking rosier than they otherwise would, which is why we've had the consistent, 24 months or whatever it is worth of negative revisions to the job market. We've had one good thing going for us in this economy for the last couple of years, and that's been that the jobs numbers have been good no matter what inflation has been doing. Now, it's very difficult to back off of that. It's very difficult to start putting out the accurate jobs numbers because that looks like a recessionary trigger. So
Mm,
who in control of an economy would want to do that?
I don't know. Well, on the brighter side, this time last year, even 2 years prior, 2023, the narrative was let's just get to 2025, interest rates will come down, things will get better, refinances will happen, the market will open up. And although interest rates are floating still below 7, they haven't exactly spiked over 7 necessarily. Um, we are seeing that the market is opening up. I am seeing more listings coming on. And about a few weeks ago, I said I'd love to see more listings in specific hot markets in PA, Chester, and Berks County. I'm seeing multi units, I'm seeing
Good.
single families, and a lot of other activity happening, which is should be giving people a lot of confidence in the market space. I don't know about you, but
Well, from our side, we've had a lot of people coming off of the sidelines. So people who have been, were pre-approved in late 2023 and thought they would jump in 2024 and waited another year and decided to lease. We have a
yeah,
lot of those people who are back in the market who are excited now, asking for pre-approval. So we too have seen a significant increase in business from March to April. And by the time April was over last year, I knew that we were going to have a spring that wasn't. You could just tell by the way the market was shaping up. April had a little flash in the pan, and then May died. This year, exactly the opposite. Our May is 33% again as big as our April was. So, like the rest of the industry, we are slowly inching towards normalcy.
absolutely. I'm really excited about everything. I've also been pleasantly surprised at seeing the market start to even out a little bit more. I wasn't sure as we were coming into the season if inspections were going to be continued in the agreement of sales, if sellers were going to be agreeing to those terms, kind of making it a little better for the buyer. Um, and they are holding. I mean, I am seeing in some markets that people are still going above asking and listed price, but I think the buyer's getting just a better informed purchase. They know what they're buying and they're getting those inspections, which is always really good. So,
Agreed. I like a market where borrowers are encouraged to be careful.
yes.
Right. So we don't, nobody does their best work when they're in a panic because the thing they're trying to buy is going to be gone in in a second. So
No, and
we
it
would,
doesn't give us confidence either,
right.
right? I mean, you're selling a property that has had 0 inspections and you're trying to guide maybe your buyer and navigate through that environment. You don't want to get the phone call 6 months or a year later that the roof was bad and they can't afford it, or just some sort of awful
And it seems
situation.
stupid because it seems stupid to say because it's obviously a part of it, but what part of what you're buying when you're buying a home is stability and the ability to have the same place year after year and to start gaining real wealth through the
Mhm.
opportunity to build real wealth. And you want to make sure that you're not entering a place that's going to prohibit you or inhibit you from doing any of those things. And that's why inspections are important. Now, there are some markets where you just have to, jump in there and use your gut and let the appraisal do some work for you and work with your agent and all that stuff. And we've been in that market, but we would love to see it, I think, cool down a little bit to the point where buyers were able to make a decision with a little more time under their belt.
Agreed, agreed. So I think on the seller side, if you've been cautious about selling because you weren't sure where am I going to go, or what does my buying power look like, or how far does this equity that I have in my property take me somewhere else, I think it's giving more confidence in the sellers too, realizing like, hey, I did accumulate all this equity in this home, and I do have an opportunity in the buyer space now that maybe they felt like they were going to get ready to compete with
Hmm.
buyers. So
It's in general, it's all looking up.
in general, it is. I think as a whole, the market is looking much better.
And
So
I do think still that given the economic indicators we're seeing, that if we had two rate improvements before the end of the year from the Fed, I think that's right in line with what I would expect to happen. So again, the long slide down is starting. We would have really liked for last week to have been the starter's pistol, and unfortunately, it looks like it kind of fizzled out instead.
I've been saying kind of since January that I think that those rate cuts will come after the spring and summer markets. I think it'll come in the fall. I think that'll be a great opportunity for refinance. That's just my own prediction. I'm gonna hold to it because um, I think it makes the most sense. I
I
think they
remember
want to
you making that prediction.
stabilize.
Yeah.
Yeah, I think they want to stabilize it through the spring and summer markets, and then bring in those rate cuts at the end of the year.
and then those and get us down towards that 3.5%, which is where they think is going to be that nice neutral gear. So I do remember you saying that. I mean, stick with it. Your
I'm
predictions
gonna stick
are
with it. It
you,
seems
you've been right at least 51% of the time. Very, very nice. And that's better than most people.
woo.
That's I tell it's like predicting the market's a very unsure thing, right? So whenever I tell my daughter sometimes, when she will get her shoes, and every single time she asks me if her shoes are right, it's always wrong. And I say, listen, statistically, if you were choosing randomly, you'd get this right about half the time. So you must be very wrong somewhere in your head to be this to be
To
this
be that wrong consistently. That you
right,
just
you're
got
just
it
wrong this
backwards.
consistently. That's not a good thing. Meghan is the opposite of my daughter picking shoes. Meghan is correct consistently about this stuff. She's
Well,
pretty
I try to be informed. I try to listen and pay attention, and I try to think about if I were in the shoes of the decision makers, what would I be doing? What would I be thinking about? Because as a buyer or seller, selfishly, I'm going to say rate cuts. Give me the rate cuts,
right.
please. Being somebody who has to make that decision, I'm thinking I would wait. I would let it simmer. I'd let the market spend some more time evening out before I decided to do that. Because if I cut them too soon, I might send a surge back into the real estate market and raise inflation. So
You also have a 6 month honeymoon period as a president and an administration, and you can bear the higher interest rates through that honeymoon period. And
yeah,
after that, if the economy goes south, you're in trouble. So you're going to need to, have a tool in your tool bag to be able to reduce rates or spur the economy in the event the economy begins to slow, because that can
absolutely.
derail the train of an administration. So I think both those things, both the positive outlook that you're giving and the slightly more cynical outlook that I'm putting on it, both point toward the same outcome. And I
Right.
think when both of them point toward the same outcome, you're likely to see that outcome.
Absolutely. Well, thanks for your time. We'll
Sure,
reconnect
happy to
sometime
do it
soon.
all the time.